Look at modern global business. It is a messy, chaotic tangle of physical logistics, complex intercorporate agreements, and unexercised financial options. Now contrast that sprawling web with the rigid mathematical structure of a blank IFRS statement of financial position. Financial reporting functions as an engineered model designed for specific predictive utility. The IFRS Conceptual Framework provides the logic that dictates how this model behaves. To master this system, you have to abandon the idea of simply counting physical objects. Instead, you construct the balance sheet from first principles, defining elements, passing recognition gateways, and assigning measurement bases. The entire system is built around a single objective, providing information that helps existing and potential investors, lenders, and other creditors assess the prospects for future net cash inflows. This diagram illustrates the first barrier to entry. Before any economic event can enter the financial model, it must pass through two qualitative filters. The first lens is relevance. The information must be capable of making a difference in users' decisions, meaning it has either predictive value, confirmatory value, or both. The second lens is faithful representation. The depiction of the economic phenomenon must be complete, neutral, and free from error. Materiality acts as an entity-specific aspect of relevance. If omitting or misstating information could reasonably influence user decisions based on its nature or magnitude, it is material and must be addressed. There is a strict definition of neutrality here, supported by prudence. Prudence means exercising caution under conditions of uncertainty, ensuring assets and income are not overstated. But it does not permit the deliberate, systematic understatement of assets or overstatement of liabilities. Only the economic phenomena that successfully survive these two qualitative lenses are permitted to move to the next stage of the assembly line, elemental definition. This table establishes the elements of financial statements, the basic building blocks of the IFRS model. The top row details the definition of an asset, strictly defined as a present economic resource controlled by the entity as a result of past events. Notice that the resource is defined as a right that has the potential to produce economic benefits, rather than the physical object itself. The asset consists of the specific rights attached to this equipment, the right to use, sell, or pledge it as collateral. To record this asset, the entity must have control, the present ability to direct its use and obtain its benefits. There is also a temporal distinction. With an option contract, the asset is the present right to exercise it, not the future cash flow itself. Some resources exist only momentarily. Employee services, for instance, are received and immediately consumed, meaning the entity's right to them exists only for an instant. By separating rights from physical form, IFRS accounts for complex intangibles, intellectual property, and physical machinery, using the exact same logical terms. Shifting to the opposite side, the second row defines the liability, a present obligation to transfer an economic resource as a result of past events. Specifically, it is a duty the entity has no practical ability to avoid.
To apply recognition criteria, we have to establish the unit of account. We must decide whether to treat a single right, a group of rights, or a combination of rights and obligations as one item for accounting purposes. Take executory contracts, where two parties have agreed to an exchange, but neither party has performed their obligations yet. In an executory contract, the right and the obligation are interdependent. They cannot be separated, so they form a single asset or a single liability, depending on whether the current terms are favorable or unfavorable. Defining elements determines the legal and constructive boundaries of the reporting entity, capturing economic exposure beyond simple cash settlements. Defining an element is only the beginning. Next is recognition, capturing an item for inclusion in the statement of financial position. Just because an item meets the definition of an asset or liability does not guarantee it will be recognized. We return to the relevance constraint. If there is high uncertainty about whether an asset or liability even exists, recognizing it might not provide useful information. The same applies to faithful representation. Every recognized element must be measured, but if the measurement uncertainty is exceptionally high, the resulting number may fail to faithfully represent the underlying economics. There is also a pervasive cost constraint.
The benefits of reporting specific financial information must justify the costs preparers incur to provide it and users incurred to analyze it. When items fail these criteria, they are excluded from the primary statements. However, the entity must still provide explanatory information about them in the notes. The recognition gateway acts as the ultimate filter, ensuring the primary statements remain a rigorous, precise summary of the entity's overall financial position. Once an element passes through the recognition gateway, it must be quantified in monetary terms. This requires selecting a measurement basis. This visualization compares measurement approaches. Historical cost is an entry value, updated over time for depreciation. Current value is a continuously updated exit value, which breaks down into fair value based on market assumptions and value in use based on entity-specific cash flows. Alternatively, current cost acts as a modern entry value, reflecting the cost to acquire an equivalent asset at today's measurement date. There is a deliberate tension here. Historical cost provides a verifiable representation of past margins. Current value provides relevant predictive inputs for estimating future cash flows. Selecting the right measurement basis is an iterative process. It forces the entity back to the qualitative characteristics of relevance and faithful representation to determine which metric is most useful. The entire system operates sequentially. Raw economic reality is translated into defined rights, passes through a strict gateway, and is finally quantified. Every number on a compliant IFRS financial statement is a deliberately engineered data point. It is part of a predictive model designed to assess management stewardship and project the timing, amount, and uncertainty of future cash flows.